Gross profit and what it signals. Analysts reading an income statement do not focus only on the final net income figure. Each profit subtotal answers a distinct question about where value is being created or eroded across the business. Gross profit is the first subtotal, and it measures the profitability of the product or service before any overhead is applied. Gross profit is what remains after subtracting only the direct costs of producing or delivering the product. In fiscal year 2025, Microsoft reported revenue of $282 billion and cost of revenue of $88 billion, producing gross profit of $194 billion and a gross margin of approximately 69%. That margin reflects the relatively low variable cost of delivering software and cloud services at scale. Operating income and EBIT. Operating income takes gross profit and subtracts all operating expenses, including research and development, sales and marketing, and general and administrative costs. Operating income shows what the core business earns after covering every cost required to run it, excluding financing costs and taxes. EBIT stands for earnings before interest and taxes. In most cases, operating income and EBIT are treated as equivalent, though they can differ when a company records significant non-operating income above the tax line. Microsoft reported operating income of $129 billion in fiscal year 2025, producing an operating margin of approximately 46%. This metric is central to valuation because it reflects earnings power independently of how the company is financed or what tax rate it faces. Part 2. Non-operating items. Below operating income, the income statement includes items that arise from financing and investing activities rather than the core business. These are typically grouped as other income or expense, and they include interest income, interest expense, and gains or losses from investments or asset disposals. In fiscal year 2025, Microsoft reported net interest income of $262 million and other income and expense of negative $5.2 billion. The negative other income figure was driven primarily by investment-related losses recorded in that period. After adding or subtracting these non-operating items from operating income, the result is pre-tax income, also called income before income taxes. Microsoft's pre-tax income in fiscal year 2025 was $124 billion. Tax and effective tax rate. Income tax expense is the final deduction before net income is reached. Companies do not simply apply their statutory tax rate to pre-tax income. The actual tax expense differs from the statutory rate due to tax credits, deferred tax effects, and differences between accounting rules and tax laws across jurisdictions. The effective tax rate is the tax expense actually recorded divided by pre-tax income, and it shows the real tax burden relative to reported earnings. Microsoft reported a tax provision of $22 billion in fiscal year 2025 on pre-tax income of $124 billion. That implies an effective tax rate of approximately 17.6%, which is below the U.S. statutory corporate rate of 21%. The difference reflects the benefit of research and development tax credits and the geographic mix of Microsoft's global income. Part 3. What net income contains. Net income is the final profit remaining for shareholders after every obligation has been settled. Net income is what remains after operating costs, financing costs, and taxes are all deducted. Microsoft reported net income of $102 billion in fiscal year 2025. However, net income includes both recurring and non-recurring items, and treating the reported figure as a reliable proxy for future earnings without investigation will distort any forward projection. Recurring versus non-recurring in net income. Non-operating items between operating income and pre-tax income can include asset sale gains, fair value changes on investments, and restructuring charges. These items may be large in one year and entirely absent the next. In fiscal year 2025, Microsoft recorded other income and expense of negative $5.2 billion, which included investment-related losses that are unlikely to repeat at the same scale. An analyst projecting forward earnings without removing such items would overstate or understate the true earnings base. Net income quality check. The most direct way to assess net income quality is to compare it against operating cash flow over multiple periods. Microsoft reported net income of $102 billion and operating cash flow of $136 billion in fiscal year 2025. The $34 billion gap is explained by non-cash charges such as depreciation and stock-based compensation, which reduce reported profit but require no cash outflow. When operating cash flow falls significantly below net income over several consecutive periods, it signals that reported profits are not converting into real cash, which raises questions about the reliability of the earnings figure. Part 4. What EBITDA is and why it exists. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA starts from operating income and adds back depreciation and amortization, which are non-cash charges that reduce reported profit without any actual cash leaving the business. Depreciation and amortization do not appear as a separate line on the income statement. They are disclosed in the cash flow statement under operating activities and in the footnotes of the annual report. In Microsoft's fiscal year 2025 cash flow statement, total depreciation and amortization was $34 billion. Adding that figure back to operating income of $129 billion produces reported EBITDA of approximately $163 billion. EBITDA is widely used in valuation because it strips out the effects of capital structure, tax, and non-cash accounting charges, making it easier to compare companies across different industries and jurisdictions. Normalized EBITDA and adjustments. Reported EBITDA is the starting point, but analysts adjust it further to remove non-recurring items before applying a valuation multiple. The result is called normalized EBITDA or adjusted EBITDA. In Microsoft's case, the one-time adjustment is minor, confirming that reported EBITDA closely reflects ongoing earnings capacity. In companies with significant restructuring charges, legal settlements, or acquisition costs, the gap between reported and normalized EBITDA can be substantial, and using the unadjusted figure in a multiple-based valuation would misrepresent the true earnings base.